Good morning, everybody, and welcome to this edition of our weekly think tank for Monday, 31st of May. My name is Carl Capilingua. I'm the market analyst over here at Think Markets Australia, and it is a pleasure to be with you as we delve into the big market moves from last week and look to what might move the market in a big way this week. We'll do that after we talk about the Think Markets difference, which is substantial: $8 flat rate trades, your own holder identification number, unlimited phone support, and no hidden platform or subscription fees. 4 fantastic reasons why your next ASX share trade should be with Think Markets. And if you are new to the Think Markets family, sign up before June 30, get trading. The first 5 trades are on us. There are some T's and C's, so head to the website for more details. The agenda for today is to check out the key moves, as I said, across the market, but we'll also look at the key economic data, see where the value lies in the Australian market, see what the charts are saying, and then look to the week ahead. We're going to kick off, as that says, with a cryptocurrency market update. We'll start with Bitcoin, the big daddy of them all. Unfortunately, if you're a Bitcoin bull, a hodler at the moment, the news isn't so good, with prices failing to rally quickly from the big Musk and China crackdown sell-off. And that is a problem from a technical point of view, putting aside all of the fundamental gyrations that occur each day. From a charting perspective, when we come down sharply, we like to see a rapid and sharp bounce to tell us that demand has sprung back into action. It's overwhelmed the panicky supply and we've set a fantastic low from which then to base our next big move off, and then draw people who have gotten out back into the market because they fear missing out. What we like to see is this very clear sort of double bottom pattern with rising troughs and a break above that sort of middle peak. The rising troughs tell us that demand is growing. The only way you can get rising troughs is if demand is building, and by breaking through that middle peak, it's telling us that supply is dissipating as well. So this is a tick. This is what we want to see. We saw the makings of it early sort of this week, late last week, with this rising trough double bottom pattern, but we haven't really been able to make any progress to the upside. We're still being resisted, I believe, by this long-term uptrend zone, which on the way up tends to act as support. Didn't do it so much with Bitcoin, I must admit. But on the way down, if we get beneath it, tends to act as resistance. So that's another problem amongst many problems, I think, for Bitcoin. The candles don't look fantastic. As I said, the price action's not looking brilliant right now. Well, that's what's happened in the past. Let's give you some cues to what to look for going forward, where things might get better, things might get worse, things will probably stay the same. Look, whilst we're within this range of, let's call it 41 to 42,000, right, these two numbers here, it's hard to see us making any substantial progress to the upside. Having said that, whilst we're trading above this sort of 29 to 30 zone, we should be fairly protected. That also means that if we break below this 30,000 to 29,000 zone, we could see another sharp sell-off. And in that case, I'd be expecting us to target this big round number here at 20,000. And there are some big past resistance levels around that number. And we know that once we break through resistance, it tends to act as support. To the upside, if we get above that 42,000, then we're more in this scenario here. Hey, whilst we're in the middle, and there's not a lot that you need to do with Bitcoin whilst we're there. So a really good roadmap of what to expect going forward. The final thing I'll point out here is we've talked about demand side, equilibrium, supply side, this transition that we often see, not just in cryptocurrency, but all securities, where we move into that sort of build-up phase, that flattening phase, and then the downturn. Doesn't mean it's over for Bitcoin. It just means that we need to build back up into the demand side market with high peaks, high troughs. And the catalyst for me, officially writing demand side back on Bitcoin would be to see this pattern here, but then one more little pullback and hold, okay, where we see this level hold above that level. And that would really indicate to me that demand is now well and truly greater than the supply, and we are back in the demand side market. Okay, next chart is the total market capitalization of all cryptocurrencies, excluding Bitcoin. So taking out the Bitcoin effect, because it is the biggest by a long way compared to the other ones. We've seen a hold of the long-term uptrend, but I would suggest it's largely to do with the biggest that's left in, and that's Ethereum. We'll see that chart next. We have seen lower troughs come in. We're still seeing lower peaks, and therefore we have to believe that we have moved from this demand side through a very short equilibrium phase into a supply side market for the time being. And all of those other comments I made on Bitcoin will still need to be observed before we can swing back to the moon case. And that's the moon up here if you're unsure of what that drawing is. Having a look at Ethereum, no sign of the moon. We are, as we said with the previous chart, dominating proceedings with the rest of the market cap there. 3008 is the key number to the upside. If we can get above that, we're looking good. 1720 is the key number to the downside. If we get below that, then we're probably going to head back to 1000. Probably the best performing of the majors is Cardano. That tends to be sort of fourth or fifth biggest in the space, depending on which day you look at it. It is showing high troughs through here. Hopefully we actually close out this candle today with another higher trough there. We're still lower peaks, but at least we can see there are some signs, at least some signs, that demand is building down here. Hard to get too excited until we broke above 186.17 to really put us back into that demand side market. But it is, the better looking one of the top 10, at least right now. Dogecoin, always very popular. Elon Musk has been out over the weekend with a couple more silly tweets. You couldn't really describe them as anything better than that. It's more in the Ethereum or Bitcoin basket at the moment with a far more subdued bounce than, say, Cardano. Again, 38.78 looks like a pretty key level to the upside. Until we get above that, I can't suggest that you would be wading into this market in any big way. Whilst it's holding above sort of 20, there is a chance that we can consolidate maybe and pull out of this. If we broke below 20, then unfortunately I think for Dogecoin believers, it's probably all over from there. So stuck in the middle, I think, is the theme for many, many cryptos at the moment. Heading back to boring old Australian shares. Look, not that boring last week. 2% gain in the ASX 200 index, but within the index, some pretty good gains. Nearly 4% there for telecoms. That was the best performing sector. 3% for technology, although that is coming off a lower base. But continued strong performances in financials. Energy had a bit of a bounce. That hasn't been one of the strongest sectors recently. Discretionary, that has been one of the better performing sectors that powered higher. And materials, I would say, underperformed, but may get a boost this week, as we'll see in the next couple of slides from higher commodity prices. Just utilities missing out, and that is by far and away the worst sector on the market right now and doesn't look even close to turning around at this stage. Having a look at the All Ords Index, this is kind of the opposite to those cryptocurrency charts we saw earlier, where we are still in a clear-cut demand-side market. I know stocks are boring sometimes compared to cryptocurrency, but hey, if you're the kind of trader that wants to buy something that then goes up, this is probably a better place to look than cryptos just for the time being. Even better, we're about to break through this February 2020 all-time high of 71.97. We closed at 7179, if I'm not mistaken, on Friday. And the key about Friday's candle is that we would ordinarily expect Friday to be a big fade-out day. We've had a bunch of Fridays where we start really well, look really promising, and then fade out by the close. We didn't see that. We saw this big white candle coming in. And the only way you can get that big white candle is that there is demand that persists all the way into the close, and there's very limited supply. Supply-side candles look like this, where the price gets beaten back down. We didn't see this. We saw this. Really, the only thing that stopped the buying was that the bell rang for the end of trading. So that is generally a really good sign that you get a continuation into the next day of that demand just picking up where it left off. And I think we will. We should take it out this week. We've got a free swing with the US Memorial Day holiday this evening, and I think that sets us up for a new all-time high this week. Fingers crossed. Otherwise, everything looks really good. We've held that short-term uptrend, long-term uptrend's intact. Candles are starting to look good again, and right at the end, we're starting to see a move back into higher peaks and higher troughs. So I'm quite bullish on the Aussie market going forward. Asian markets are starting to look really interesting as well. I don't have a chart for you today, but that Shanghai Composite in particular looks very interesting. You might want to go and investigate that one. US markets, I do have some charts for these in a second. They're looking fairly firm and certainly better than they were just a couple of weeks ago with some reasonable gains. European markets also higher during the week. Here's the chart for the S&P 500. I'm not as excited about this one as I am for the ASX 200 because it looks like we're in a bit more of an equilibrium phase at the moment. And we saw from that Bitcoin chart that equilibrium phases can turn into supply side phases. We don't want to see that. Hopefully, and this is my expectation here, is that the overall trend, the overriding trend will pick back up again. And we will break to new highs, which will take us back into the demand side market. So I'm quite optimistic on that. I'll explain why when we get to the economic data. NASDAQ doesn't look as good because this one is clear-cut equilibrium at this point in time. And happy to trust the trend like the S&P 500. The base metals complex higher, significantly higher during the week. Big gains there. Aluminium up nearly 7%. Nearly 9% on nickel, nearly 5% on tin, and some good gains everywhere else. Copper over 4%, very encouraging. Clearly missing out there. Iron ore still suffering in the wake of those Chinese crackdowns on speculation in the steel industry. Gold and silver moving nicely higher. I've got a gold chart for you coming up, but before we do, we'll just note that we've had a nice bounce in copper, and it seems to be just doing this step-up pattern off its short-term dynamic trend zone, and looks very good to continue. Long-term trend very clearly up. Nickel has had a bit of a tough time of late, but seems to be holding well enough now to say that I think we're moving back into a demand-side market, so that is encouraging for nickel stocks. If I could give you one that looks very interesting today, I would suggest go check out IGO. Looks pretty good. Having a look at iron ore, more damage has been done than potentially the other two. Having said that, we are still very much in trend, and I don't want to discount iron ore just yet because the overall strength of the trend is still very strong. But long story short, a lot of damage has been done, so a little bit concerned there. Not so concerned about gold. We're seeing a really nice turnaround. Here's the higher troughs. Here's the breakthrough that middle peak. Here's the rally and the retest of that middle peak to throw us back into the demand side market. So isn't that wonderful? We get to see a really relevant case study so quickly after that Bitcoin discussion to show us what we need to see moving forward. And then, off we go into the traditional sort of demand side market where rallies are bigger than the pullbacks. Look, gold looks pretty good. I can't get too excited about it because there are some big resistance levels not too far away, which I think will probably just suppress prices in the short term. But overall, happy to back gold stocks. Having a look at the energy complex, that was very strong during the week, but overall energy prices are quite flat over the last month or so. Aussie dollar was down, probably more to do with the iron ore than the other items, because otherwise they're quite bullish for the Aussie dollar. The US dollar fairly flat for the week, but off its lows. Having a look at bond yields, they came down quite substantially during the week, nearly 5 basis points there on both the Australian and US 10-year yields. Definitely a downtrend in Aussie bond yields at the moment. We'll take that as stock traders. We'd rather these yields be at the bottom of the range, certainly, than the top of the range. We don't want to see them break too much down here because it would mean that the Australian economy is in some sort of danger of slowing down or contraction. So that we don't want that. We certainly don't want it up here because that would mean we're in a significant sort of inflationary pulse. So in between is all goods, and much is the same here on the US bonds. And this is the key move here on Friday. So look at that little down move. That's yields coming down, which means bond prices have gone up. Once again, we're in the middle of the range. Now, I'll talk about why that's important in a second, but firstly, let's just talk about where we are this time. So this is now versus the 2007 GFC recovery, and we have been moving lockstep. That's kind of the little joke that we've been running on Monday mornings now for over a year, and we've each time there's a big downturn in the red line, we go, well, the orange line's probably going to turn down as well. Look, this time we saw a little bit of a wobble at that point, uncanny as it is, but then we haven't turned down. We've actually been holding higher. So that's very interesting. Maybe, before too long, I'll have to get rid of this chart because we're not moving lockstep anymore. And that would be nice because it would mean that we're heading up here and we could dispense with this silliness. It's just a little bit of fun we have on Mondays. Don't take it too seriously, but hey, you never know. They say that history doesn't repeat, but it sure does rhyme, and it appears to be rhyming at the moment. Looking at durable goods orders, a big miss there, and I think that also contributed to those lower bond yields during the week. We got a 1.3% contraction, and we've seen a couple of bad months now on durable goods. That was compared to the market expecting a 0.7% increase. Durable goods, very important for me. It's one of my favourite economic indicators because durable goods are big ticket items. So it could be a fridge, it could be a tractor, it could be a new airplane if you're the US military. And those few examples demonstrate that durable goods reach across all sectors of the economy: consumers, business, government, and you're only going to buy a durable good if you're really confident in your situation. So it's a more forward-looking indicator as well, and it's not great for the US economy to see that contracting. We also saw a bit of a flattening out in consumer confidence as well, but on the flip side, we saw a pretty decent print on the Chicago PMI. A lot of that was order backlogs, just showing that the businesses are struggling to get the components they need to deliver the products they've promised. And we did see continuing good news on the jobs front with another decline in those weekly jobless claims, but there are still over 15 million Americans collecting some form of unemployment insurance at the moment. Having a look at personal income and expenditures, they were roughly in line with expectations. So we'll discard those as being too market moving. The big one was the core PCE price index. Now, PCE stands for personal consumption expenditures, and this is the Fed's preferred measure of inflation. So the other measures are the consumer price index and producer price index, but this is what the Fed likes to look at. The Fed wants to see inflation around about its 2% target. This one came in at 3.1% year on year after the 0.7% increase in April. That was ahead or above or worse than expected. Expectations were for 2.9% on this number, and we got 3.1%. Now, this is the core reading. It strips out the volatile energy and food components. Now, I would suggest not a lot of value in that because as consumers, we don't get to do that. We do feel those rises in food and energy prices. The headline number was actually 3.6%. So somewhere between here is probably where we're at, and it's not looking good in terms of inflation. So a really bad print if you want higher stock prices and higher bonds. But if you remember back to the charts we looked at earlier, stocks didn't move, they certainly didn't go down, and bonds actually rallied. So what this tells me is that as bad as that number was, markets are starting to grow more comfortable with this idea that we are in an inflationary pulse. Whereas we saw sharp falls in stocks and bonds on the CPI and PPI data, which were bad as well, this time around, markets didn't respond as poorly. So again, that indicates to me we are moving out of this phase where inflation is a really big problem for the market. Let's not get ahead of ourselves. There's still a long way to go, but it's a really good start. Having a look at where the value is in the Australian market, or if there is value at all. Now if you look back long-term averages, 15 is pretty much an average PE for a stock market. We're at 17.73, so that would indicate up here we are expensive and down here we are cheap. So we're certainly not looking too cheap at the moment, but we're looking a lot cheaper than the rest of the world at 19.24. Where is the value within the Australian market? Well, way less than 15 is the materials sector at 11.9. That is definitely looking like a very cheap sector of the market. Energy's looking about fair value, but is the next cheapest, and then financials about fair value as well. And then they fall away from there, with information technology being by far and away the most expensive at 53 times next year's earnings, but that is less expensive than it was, say, a month ago when it was 66.8. Having a look at some of the technical insights here, and we're looking at the short-term and long-term trends of the various ASX sectors. And don't forget, from our charts before, we had a light green zone and a dark green zone on the way up, and they tended to be pink and red on the way down. But the short-term trends and the long-term trends. And pretty simple stuff here. 2 greens means go. If you've got some ambers in there, you might want to be cautious, and if you've got reds, you certainly wouldn't want to go there. So we're free to buy, go out and buy and look for bargains in the broader market, yes, but within the market, the discretionary financials, gold, healthcare, materials, property, and telecoms. And I would still be avoiding or be very cautious towards energy, information technology, and certainly utilities, which is the worst of the lot. Now, this is quite an improvement from last week where we had far more sort of oranges and reds around. So that is a very encouraging sign. And also encouraging is how we're going in terms of our market breadth. So this is the number of stocks participating in this ASX 300 rally. We said earlier we're about to move to all-time highs, fingers crossed. And on screen, we're seeing how many stocks are trading above their 5 period, 10 period, 21 period, and so on, exponential moving averages, all the way out to 252, which is 1 year. Because when you consider there are only 5 trading periods in a week, okay, this makes this 2 weeks, this makes this 1 month, 2 months, and so on. So where are the current prices in comparison to those trends as you go longer and longer? Well, the good news is we've got 4 out of 5 stocks trading above their 1 week trends, and that pretty much holds out to 2 week trends. Amazing. And then we're sort of around 2/3 all the way out to 1 year, and that is a very, very healthy statistic indeed. If you go back to February 2020, that's the last all-time high. On that day, we were at about 60%. So we are actually better than really we've ever been. And just to put it in perspective, this is where we were at the lows at the worst of that COVID disaster. And you can see really less than 10% of stocks actually above their moving averages. So this is a big tick for me, and it has improved markedly over the last week and over the last month. So that is very encouraging for higher ASX stock prices going forward. Having a look at what's coming up this week, by far and away the biggest announcement this week on the economic data calendar is the Reserve Bank interest rate announcement over here. No change expected there, but we'll be looking for them to expand on their commentary around, recent inflation data, recent economic data as well regarding the strength of the Australian economy, and hopefully that they will continue to stay the course on their very loose monetary policy. Other than that, pretty quiet week locally. Heading to the Chinese and US data, they tend to be the most impactful for Australian shares at least. We do have some important manufacturing data coming out today with those PMIs, and we'll see those reflected on Tuesday night with the US equivalents. And then the big data released down the bottom there is going to be the non-farm employment change and unemployment rate. That is the biggest released globally really on the monthly calendar, but we'll also have a speech from Jerome Powell, for the chairman of the US Federal Reserve, on that Friday also. So a very interesting week ahead. If you want to stay abreast of all of those big market moves, you need to head to the market news section of our website, where we'll have all the news, views and opinions and analysis for you. If you like, you can follow me or the Think Markets handles for regular updates on Twitter. Also head to our webinars section of the website to register for our upcoming webinars tomorrow. I'll be showing you how to spot trading signals using price action. The week after that, bring your portfolio to the table and ask about any stock you're interested in with Ask the Experts. And then on the 15th of June, we've got 3 ASX mining stocks for you to look at. That's it for me today. The disclaimer before I leave you says that everything we've discussed is general in nature. You should do your own research before making any decisions. And also don't forget, we do have some products that could see you lose more than your deposits. So read this disclaimer carefully. And if you have any questions at all, feel free to give us a call. Well, thanks for chatting with me this morning. All the best for your trading until we catch up again. Bye-bye for now.